Okay, so one of the biggest, fastest, most brutal market crashes of the year just happened. We're talking about precious metals. And honestly, if you blinked, you probably missed the absolute carnage. So let's break down exactly what went so wrong so fast.
Get this, in a single day, silver just had a record-shattering drop of 36%. Let me say that again, 36%. To put that into perspective for you, that is the biggest single-day crash in its entire history. Just wow, absolutely historic.
And the total damage? A staggering $7 trillion in value. Just poof, vanished from the precious metals markets. No, that is not a typo. 7 trillion with a T.
So, as you can imagine, investors are absolutely reeling, portfolios are bleeding out, and pretty much everyone is asking the exact same question. What on earth just happened? Well, that's what we're here to do. We're going to break it all down for you, piece by piece. All right, first up, let's set the scene here. Because this wasn't some kind of slow burn, This was a flash fire. So let's just walk through the timeline of this incredible 72-hour collapse. I mean, what's just wild here is the sheer speed of it all. Just look at this timeline. On Thursday, January 29th, the market is totally euphoric, right? We're hitting all-time highs. Then, just one day later, on Friday the 30th, the floor completely gives out. I'm talking historic, record-breaking losses for both silver and gold. And by Monday, the damage is already spreading globally. ETFs, other markets, they're all getting hammered. A complete 180 in just 3 days. Insane. So, the big question is, how does a market go from total euphoria to sheer panic that fast? Well, it wasn't just one thing. Nope, this was a perfect storm, a convergence of three really powerful factors that all hit at the exact same time. And here they are. First, you've got the so-called hot money from Chinese speculators, and it just suddenly vanished. Second, a surprise nomination for the next Fed chair sparked a massive dollar rally. And third, you get this cascade of forced selling from traders who were way too leveraged. So let's dig into how these all combined, starting with those speculators. Okay, so for weeks, traders have been watching prices just surge during Asian trading hours. Now, this wasn't your typical institutional buying. This was a flood of hot money from Chinese retail investors, from funds just chasing the momentum. They're the ones who pushed this rally into a completely unsustainable parabolic curve. But here's the thing. When prices wobbled at the top, they didn't buy the dip. They took their huge profits and they ran, basically pulling the rug out from under the entire market. Right at that same moment, news breaks that President Trump is nominating Kevin Warsh as the next Fed chair. And the market, well, it immediately saw Warsh as hawkish, which really just means he'd be more likely to fight inflation than, say, cut interest rates. This whole perception, this one piece of news, caused the US dollar to suddenly spike higher. So why does a strong dollar even matter for gold? Well, this explains it perfectly. It's a really simple inverse relationship. You see, precious metals are priced in dollars. So when the dollar gets stronger, like it did on the Warsh news, gold and silver instantly become way more expensive for anyone holding other currencies. And what does that do? It just crushes foreign demand and puts immediate downward pressure on prices. Now, those first two things, the speculators leaving and the dollar surging, they triggered the third and final nail in the coffin. Margin calls. For anyone who's not familiar, a margin call is basically your broker calling you up and saying, hey, your bets are going really bad and you need to put more money in your account right now or we're going to sell your positions for you. It's not a call you ever want to get. So here's the really crucial point. What happens when thousands of traders, all of whom borrowed money to bet on higher prices, get that exact same call at the exact same time? You get a death spiral. Brokers start force selling their positions, which of course pushes prices even lower. Well, that triggers even more margin calls for other traders, which leads to even more forced selling. You see, it's this vicious cycle that just feeds on itself, and it's what turned a simple price drop into a full-blown catastrophic crash. Okay, so we know why it crashed, but that brings up another question. Why were prices so incredibly high to begin with? Was it all just a speculative frenzy from the very start? Well, not exactly. Let's take a look at the real fundamentals that were actually supporting the market.
See, before all the mania kicked in, there was a legitimate bull market happening. You had central banks, we're talking China, Russia, India, buying up gold at a record pace to get away from the dollar. Geopolitical tensions were super high, and there was real growing industrial demand for silver in things like solar panels, EVs, even AI, which led to a multi-year supply deficit. These are all real, powerful, fundamental drivers.
But, and this is the absolute key, while all those fundamentals supported higher prices, they in no way, shape, or form justified that vertical, parabolic move we saw at the very end. Gold at 5,600, silver at 121, that was pure speculation. That was a bubble. And as we all know, bubbles always pop. So, with the bubble now spectacularly burst, the big question is, where do we go from here? What's the expert outlook? And, what does all this volatility mean for the average person just watching their investments? Well, the general consensus view kind of splits the future into two different timeframes. In the short term, you should probably expect more chaos. I'm talking violent bounces, maybe another drop as the last of the forced sellers get flushed out of the market. But, and this is important, looking further out, those core fundamentals we just talked about, the central bank buying, the industrial demand, they haven't gone anywhere. In fact, you could argue that lower prices might even accelerate that long-term trend. So what does stabilization actually look like in terms of numbers? Well, analysts are suggesting the market will probably consolidate in these ranges for the next few months. For gold, that's somewhere between $4,000 and $4,800. For silver, a pretty wide range between $60 and $90. Now, that's a far cry from the recent highs, for sure, but it's still well above where we were just a year ago. Okay, and look, this isn't financial advice, obviously, but it is a really helpful framework for thinking about how to navigate this kind of insane volatility. It really all comes down to avoiding emotional decisions, right? Like panic selling at the absolute bottom. And maybe most importantly, it highlights the real danger of leverage, that borrowed money that was the downfall for so many traders in this exact crash. All right, so we've covered the what, the why, and the what's next. But if you take away just one single lesson from this entire mess, what should it be? It's this. Parabolic rallies, when a chart goes nearly vertical, they always end badly. It really doesn't matter if it's gold, a tech stock, or heck, tulip bulbs back in the 1600s. What goes straight up eventually comes straight down, hard. So the real question for all of us isn't just what asset is building the next parabolic curve, but can you tell the difference between a solid fundamental trend and a speculative frenzy before it's too late?